So my name is Michelle Castle. I'm with Guild Mortgage in Sherman, Texas. And what we're talking about today is the pre-approval versus pre-qualified process. What really kills the deal and what you want to avoid so that you don't have any pitfalls in that whole loan processing. There is nothing worse than getting down to the end and something falling apart because of something that was overlooked in the very beginning or never even asked for or questioned. So we're going to go through some of those. Now, of course, the business has changed. The industry, the guidelines have changed a little bit in the last couple of months. So we'll talk about that too. Some of it might go back to the way it used to be and some may not. Some of the guidelines may be here to stay. So we'll be sure to review those as well. I'm going to share screen just so it's easier for you guys to follow along, and it will also give you guys the ability to write down the information. So what we'll go over is you guys really need to know the difference in pre-approval versus pre-qualification. And it's not just because you know how to read the words on the top of the letter, because that is only part of it. So once we go over the differences, then you're going to feel a lot more comfortable about asking the lender the questions that you need to be asking to make sure what you're looking at is an actual pre-approval and not just a pre-qualification that looks and is completed on a pre-approval letter. There is a difference. The credit issues that come up, the income issues that come up, the asset issues that come up and can cause a problem are all three going to be addressed. And then we'll talk about what we do in order to avoid those on our end. So the goal of the class is for you guys to be more educated, and more than anything through education, you guys are more confident about what you're looking at and what questions that you need to be asking, because at the end of the day, that's what I hope for all of you guys is that you're a lot more confident in the transactions and knowing what you know because you attended these classes. And then we'll just talk about how you can make sure that your buyers are actually pre-approved before you put them in a car or meet them at a house to go look at property. It is only fair, and I tell the buyers this all the time, if I am a seller, and I have been many a times, I don't want people inconveniencing me to come look at my house if they can't write a check. And if they can't write a check, then can their lender write a check on their behalf in the next 30 days? If they can't, don't inconvenience me to come look at my house because you're not ready and you're not serious. And I think as a seller's agent, that should be the position that you take to do what is best for your seller. It is, y'all, we're busy. I don't want people in and out of my house. And it is even more serious now with the virus going around. And then the third thing is just to eliminate those sales that fall apart at the last minute over the little things that maybe could have been caught in the very beginning. The thoroughness of a pre-approval matters, and that is all really different from lender to lender. For example, I have a guy that called last night, and he's really upset because we are waiting to issue a pre-approval letter until we have his mortgage statement and proof of HOA, or the cost of the HOA on the house that he's retaining. But whenever I explain the reason that that is so important, if you've got someone that's really high on their debt to income, and we're assuming that his HOA dues are $50 a month and we find out they're $150 a month, it could kill the deal because we didn't ask enough questions. And some lenders are they're just busy and they're just sending off letters after they pull credit and look at income or look at pay stubs without asking the questions. And some of them are just don't understand the importance of getting that done in the front end. So when we go through this, I want you guys to be comfortable with asking those questions so that you know if the lender is just one of those that's just quickly writing letters or if they're actually doing their part to make sure that you don't have any snacks. But yes, just like Megan said, why waste everybody's time if the deal's not going to work? So the pre-qualification, these are the things that you should know about the difference in the two. A pre-qualification can be done like that. So if someone does an application online, we pull credit report and we're looking at the information as they provide it to us on that loan application. We can even run the AUS. We learned last week what the AUS is. Fannie Mae is desktop underwriter, Freddie Mac is loan prospectus, then they both are considered AUS, automated underwriting systems. So we can run AUS and we can get an approval through AUS, but that's still just based on the customer's information. In just a little bit, you'll learn why that's a big deal and why that can be such a game changer whenever you actually document the information. So a pre-approval, we take it one step further and review all of the documentation. But you also need to know what documentation is needed so that you can request the documentation and review it. Now, the other two things that I want, or the other thing that I want you guys to be very well aware of, it takes a lot more time to do a pre-approval. And whenever y'all see what all we have to do in order to issue a pre-approval, you understand why it takes more time. So you can prepare your customers for the fact that we are basically pre-underwriting their file, and it's not something we can do in 15 minutes. Sometimes it takes us several hours to get these done, at least several hours. So the traditional documentation, remember, it is our job. We are liable for verifying through a third party everything that is on the application. So whenever someone completes their employment, we have to verify it. When someone completes their income, we have to verify it. Through a lot of the automated systems, sometimes we can get the verifications automatically, and then we can compare it to what the customer told us. Sometimes it's garbage in, garbage out, so the data is not always accurate, and we need the additional documentation to prove that the data that we've received is not accurate. For example, oftentimes we'll get someone who's been on the same job, same employer. In 1 year, the income will be broken out to a base income and other income. And the next year, it'll be base income and bonus. Well, the system will not do a 2-year average of other and bonus together. So now all of a sudden I have other and I have bonus income I can't count. So now I'm going to have additional documentation to prove what it is 2 years back. And that additional documentation is not super easy because a W-2 does not break out base from other from bonus. But without knowing what that income was both years to do a 2-year average, I can't use that in the average figures. So a lot of times, even whenever we get the automated income verifications, we're still going to need pay stubs and we're still going to need W-2s. And sometimes we're going to need some further documentation to prove that the information that we have is not correct. Now, another step further right now, what we're dealing with in COVID, W-2s for last year, W-2s for the previous year. And then you look at the year to date for this year and it does not match up. They are not on track for what they had been averaging the past 2 years. Okay, well, is it because they were furloughed or was it reduction in hours? Like, those are all the questions that we have to ask. And if we don't ask those questions and we make assumptions, then our pre-approval is not legit. Bank statements or any of the asset verifications, we try to do those automated because when we put a bank statement in the file, the underwriter could scrutinize the transactions on that bank statement. And we're not looking to see where they spent their money and how many times they go to Chick-fil-A in one day. What we're looking for is any miscellaneous deposits that aren't documented by a pay stub. And that all matters too. If we've got some large deposits and a customer says, yeah, I can come up with 20% down payment, and then we get a copy of their bank statement and their average balance for the last 2 months has been $500 and all of a sudden they have a large deposit, I got to document where it came from. And I got to determine whether or not that documentation or where it came from complies with the loan qualification or the loan guidelines. Again, if I don't ask for that information up front and it becomes a problem later, it could be a deal killer for everybody that we could have addressed up front if we had just taken the time or just told everybody, hey, listen, I need you to be patient. This takes a little bit of time for us to do it right. I could do it quickly, but that's not doing anybody any favors. And then if they're self-employed, we're going to have business and personal tax returns for the past 2 years. Now, the system will tell me, based on a 2-year average, whether I'm going to need 1 year or 2 years of tax returns. Once I get that information, then I can analyze the income based on whether or not it's 1 or 2 years, but I got to have 2 years to start with. And then the other thing that is a COVID guideline is If you're self-employed, you guys start cringing because it really is that bad. If you're self-employed, we have to have a year-to-date profit and loss statement supporting the past 2 years of average income as reflected on their tax returns. So we got to have the personal returns, we have to have the business returns, we have to do a 2-year average. Then we've got to have a profit and loss statement, and we got to compare that average year to date to the past 2 years. But we got to go one step further. We also have to have bank statements that match the P&Ls. And if they don't do that, then they have to have an audited P&L. And an audited P&L right now, where we have a tax deadline, is going to take some time. And it also is extremely expensive to have an audited P&L. It's several thousands of dollars. So if you've got a self-employed borrower, you know that they're in business for themselves, they have got to get pre-approved prior to looking at houses. It is not business as usual. It's going to require a lot of paperwork. And a lot of your smaller self-employed businesses, how many of you guys are keeping up with your P&Ls once a month? Are y'all producing P&Ls? Neither are a lot of your small businesses. And it's not really easy for them to do quickly. So if you've got someone that is self-employed, that is thinking about buying a house, they need to start early in getting their pre-approval done. Now, Texas law is very specific about what that pre-approval letter looks like. The letter that we use is the Texas promulgated pre-approval letter. We can make, and you will start seeing, we've got a new program that we'll be using starting next week that is tied to our current system that allows us to run a bunch of scenarios. And it will crank out a pre-approval letter that has the same terminology as our pre-approval letters do now, but they look a lot prettier. So be looking for our pretty pre-approvals. The average FICO score by age, I just wanted to throw this in there just so you guys know and understand. When you're talking to your young home buyers, typically they have lower credit scores. And the reason is because they just don't have years and years of credit history. And a lot of times they're a little bit more leveraged than your seasoned buyers. So if you I'm not telling you to stereotype people, I'm just giving you an idea of what the national average credit score is per age. And remember, we talked about this before, the credit score, that the consumer credit score is going to be different than a FICO credit score. So oftentimes whenever someone, and we have that conversation all the time, what are your dreams? What are your goals? Short-term and long-term. What's your budget? How much money have you saved up for your down payment and closing cost? And what do you think your credit, what are you looking for a monthly payment? And what do you think your credit score is? Once we have that information, it's a lot easier for us to at least put them in this category. Okay, when you complete your application, just go ahead and check FHA. It doesn't mean that that's the way we have to go, but it sounds like that might be a great option for you. Once we have all of your information, we'll present all of the options available to you, and we'll make some recommendations and you can decide. But that information and knowing what their credit score is on the consumer side helps us determine what we anticipate that credit score to be. Whenever we pull a report, it's going to be a little bit less typically. The credit score, the credit report itself, there's a couple of things that credit reports no longer report. Y'all, this is a big deal. Credit reports no longer show judgments. They don't always show the short sales. They don't show the foreclosures and tax liens in a lot of cases. We as a mortgage company have decided, or not just we as a mortgage company, we as in Michelle Castle and all of her branches have decided that we are going to spend the money to do what's called a fraud report. Fraud Guard used to be called Fraud Guard, something else now. Maybe it is got Fraud Guard. Anyway, we pull that when we get a contract just to make sure that these things are not sitting out there that we're unaware of. But it still doesn't catch all of these public records. The public records are most often caught on the title commitment, which is why that class next week is super important. The title companies are aware of the changes, and they try to get those title commitments to all of us. You guys, the buyer, the seller, and the lender, get a copy of that title commitment as soon as they've done their research. And you have got to pay attention to Schedule C of that title commitment, because that's where the public records will now show up. If there's a lien, if there's a judgment, if there's been a foreclosure, if there's been a short sale, all of that stuff will affect the mortgage transaction. So you have got to pay attention. Those judgments and liens have to be taken care of in most cases because they will and can attach to the property. Texas homestead laws protects us a little bit, but they still need to be addressed. So don't overlook that Schedule C. We'll be watching too. So the fraud guard, some of the things that you need to know and understand, like a bankruptcy. If someone's had a bankruptcy, it will determine when they can buy a house again and what loan program we have to use based on the discharge date, unless they're in a Chapter 13, and then they can buy in a Chapter 13 with the trustee's permission on a couple of the loan programs. So all of this information matters. We are looking for how quickly, and this shows up on the fraud guard too, how quickly or when it was that the seller took title to that property that the buyer is buying, because that matters too for the flipping guidelines that are in effect on FHA transactions. And then all of the addresses that a customer has ever, any of the properties that they own, oftentimes they will forget that mama deeded them some property in Arkansas and they forget to put it on the application. Well, what we've got to do is get it put on the application, and we've got to add any tax or insurance liability or any other payments related to that piece of property in Arkansas. And so we're looking at fraud guard for all of this information that is not on the credit report but could affect the transaction. A lot of lenders will wait till the loan is approved or submitting it to underwriting for approval before they even pull that fraud guard. Again, one reason why it takes us a little bit longer on the front end, because we're trying to save some of the problems that could arise on the back end by pulling some of these reports. So, you know, we get people ask all the time, well, I can go buy a house. I mean, I could go buy a car that costs the same amount of money a whole lot easier than I can a house. Well, of course you can. And if they went through this course, they'd understand why. A little bit different. Carfax is a lot easier than a title commitment on a title policy on a house. So income, some of the things that we've got to look at on income side. If someone is receiving and having to use commission income in order to qualify, we got to have 2-year average. You guys, W-2s don't break out commission. So we have to have the verifications from the previous employers. Now, if they've had 3 employers because they worked in the car business and they've been primarily on commission income, we've got to get verification of the employment from all 3 of those employers for the past 2 years and break out what their commission is and do a 2-year average with the year to date. Now, the year to date's got to be in line with the past 2 years of previous. So again, it takes a little while. Whenever you've got multiple employers for the past 2 years, it's going to take us a little while to gather that information, because employers don't just pick up the phone automatically and say, oh yeah, here's all your information. A lot of times it's a lot of phone call, resending the forms for them to fill it out and send it back, because we want that information in writing. Overtime cannot be counted unless it's a 2-year average. Bonus is the same way. So a lot of times people complete an application online and they will include their income and just lump it as their base income when it's not base income. So if we didn't ask questions and we didn't ask for documentation and we just went on what they said, and they said that they made $5,000 a month, and what they meant is they've been averaging $5,000 a month for the past 2 years, though they had not even been in a commission sales environment. They've only been on commission for the last 6 months. We can't use it. And that's a problem, which is why we ask those questions and ask for the documentation. Now, the other thing that we got to look at is we got to compare the past 2 years and look at the year to date, especially right now, because we are dealing with a lot of furlough and reduced hours. If someone was furloughed, we can go ahead and do their loan once they're back to work, but I need a 30-day pay stub showing that they're back to work and how many hours they're back to working. Declining in any kind of income. So again, with the forbearance and furlough, I said forbearance, I think a while ago I meant furlough, but with furlough and reduced hours, there is some declining income. If we've got declining income, I have to go off of their current income, not the past 2 years. Self-employment, we talked about those income calculations. Profession changes. So a lot of people ask all the time, well, what if I've been a fireman for a long time and the schedule's just killing me? So I am going to go to work as an insurance adjuster. Is that okay? Well, it really just depends on the loan program that we're using and what the income as an adjuster is going to be. You know, are you going to be on a base salary? And so those are questions that we got to be able to get answers to in the documentation. If there's any gaps in the employment, so if someone is furloughed and they don't return to work for 9 months, then there is a gap in employment, and each loan program is very specific about how long that gap can be before you have to be back on the job for 6 or 12 months. So that gap really matters, but a lot of times people complete an application, they'll just go off of memory, which is fine as long as your memory is pretty darn accurate on the dates that you were at each job, because if there's too big of a gap, then they may not be able to use VA financing because of that gap. Relocation in a new job. We have a lot of people moving to Texas, and all we have to have if someone is relocating and they're being job transferred is a transfer letter stating that, you know, with any changes in their employment based on, or income and employment based on the transfer. But if it's a brand new job and they're being relocated, we are good to go with an employment letter as long as we have a similar line of work as our previous 2-year history. The other gotcha for Texas is we are a community property state. So those of you guys that are new to this business are going to be like, that is weird. Why does it work that way? Well, on an FHA loan and a VA loan, the spouse's debts, whether or not the spouse is on the loan, it gets included on that loan application. If the spouse's credit is not good enough to be on the loan, or the spouse does not have any income, we still have to count that spouse's debts against our borrower, the spouse that will be on the loan. So oftentimes you've got one spouse that has a ton of debts and just doesn't have a whole lot of income. So we will say, hey, listen, we're going to be okay, but you're going to have to go conventional. And the reason is because conventional, we can do the loan in just the spouse's name that qualifies and not count the other spouse's debts against them. So that's just kind of a little FHA, VA versus a conventional quirk. So interchanging the two programs, hey, we just went and looked at this property, it won't go FHA, but it would go conventional. You know, those are the conversations that you need to be having. Or if we say, hey, you're going to have to go conventional, so just, you know, make sure that you write that contract accordingly. Your pre-approval letter, you really need to think of it as your prescription. You can't write a contract without a pre-approval letter because the pre-approval letter tells you how to write the contract, just like a prescription tells the pharmacist how to fill a prescription. Assets, large deposits matter. We talked about that a while ago. So if you know that someone is getting money from a relative, or then we need to know about it. Tell us, or make sure your customer your client has told us. If you know that your customer is having a garage sale this weekend and they plan on selling a bunch of stuff for part of their funds for closing, that is a problem, and we need to talk about it because that would be a large cash deposit I can't track. So those are conversations that we need to have so that we can make sure that there's not any issues. Sometimes the number of reserves required is super important, especially if someone's buying investment property. But even that, if they're a borderline, barely have the credit score we need, debt to income is really high, haven't been on their job for very long, on their current job, like all of these risks stacked up, the number of months of reserves, which is basically how many months of payments do you have in a savings account as a reserve, matters and could make or break that deal. Which is why we have to have bank statements, because we need to know specifically how much money they have in the account so we can tell them, this is how we got your loan to work. Don't deviate from this, which means you're going to have seller concessions because I've got to have this money in the bank for your reserves or the loan won't work. Retirement withdrawals have to be handled correctly and in a timely manner. So if funds for closing are coming from 401k, you guys, we not only have to show that they have the money in their 401k, that they've received the money from their 401k, the terms of receiving the money from their 401k. And if we're using 401k or retirement funds as reserves, we have to have a letter from the 401k stating that it can be used that way. Because some of the 401ks, you can't touch the money until retirement. So just because you have the money sitting there doesn't mean you can use it until you're of retirement age. I can't use it for reserve if you are 45 years old and you're that far from retirement age. Overdrafts, transfers, business assets. If someone's using business assets for their funds for closing, there is additional documentation. We've got to have a letter from the accountant stating that depleting or using those funds for a personal transaction would not affect the business's ability to function. So that matters too. And then of course, undocumented personal property sales. So a lot of people say, well, I'm just going to sell our Sea-Doo, or I'm going to sell my four-wheeler. That's great, but I got to have a copy of the title. And some of those recreational vehicles do not have titles. So if I can't prove ownership, I can't prove that's your money whenever you go to sell it. So all of those conversations matter, which is why we ask so many questions up front. So please, please, please tell your customers, you're buying a house. It's going to require a bunch of paperwork. It's going to require patience, and you need to get all of this stuff to the lender right away so I can get you out there and looking at these houses before they're sold, because they're selling super fast. Now, some of the things that we do to use technology to expedite, we work through account check. So when a customer completes their application online, we instruct them, and you can instruct them too, to be sure to allow us to automatically retrieve what documentation we can to avoid asking them for additional documentation. So account check is a service that communicates with the banks and pulls the information that we need from the bank and puts it right into that file for us. And then we're not looking at bank statements, we're looking at the bank activity that is absolutely necessary for the loan, no more, no less than what we need. Bank statements is sometimes more than what we need. Not all banks are on that service. They are, every day they're adding banks to that service, but some of your smaller local banks may or may not be on that service, and we need to get them added, but it's not going to be added fast enough for your pre-approval. It'll just help in the future. Equifax is an automated service that we use for our verification of employments. A lot of the larger employers are on Work Number, and so their verification comes straight over. And if that doesn't work, then we have a second system that we use called Veritax, where we can get that information electronically too, but it takes 2 to 3 days. So if you call and you go, hey, it's Wednesday, we're going to go look at houses on over the weekend, I need to get the pre-approval done, I may not have time to get the Veritax, which means I'm going to need pay stubs and banks and W-2s from the customer versus waiting on getting the verifications. If you give us enough heads up, we can make it super easy on the customer by doing all of these verifications for them instead of them sending us paperwork. It's just all about timing. And then there are times when we don't even have to have appraisals right now. So this is what Fannie Mae on conventional loans calls day one certainty. It's just the ability for us, literally, there are times, I'm not kidding, I can take an application, they bank at Chase, they work for Global Tech, they only own one house and they're keeping it, they'll sell it later, and they're buying a house in O'Hanlon Ranch, and the system notices enough sales activity in that area that they feel comfortable with that value. I don't have to ask for bank statements, I don't have to ask for employment verification, and I don't need an approval. We love those loans. In our rural area, we don't see that quite as often because our employers are not all the big employers. Not everybody's banking at the larger banks because we don't have the larger banks on every bank corner. And some of our properties are not, they're just unique properties, which is why you guys work with local lenders, because we know how to work our unique properties. So we don't see that as often as we would if we were in the Dallas area. The high touch part of it. So a lot of lenders are going straight automated, and you guys are going to experience a lot more of this moving forward, where you're the mortgage companies that you're dealing with are just trying to do total high tech, and if it doesn't fit in that square peg, Like even Chase was saying, hey, we're at max capacity. We can't handle any more loans. So if the credit score's not over 740 and they're not putting 20% down, we're not doing the loan. And then even at that, if it doesn't go through the automated system, they may or may not choose to do that loan. They just don't want that, you know, that interaction, and they just really don't have the people to analyze the files the way they need to be analyzed. So if they don't go the high tech direction, then they're just like, you know, sorry, we can't help you. We won't ever be that way. We're always going to be that people. I mean, we just like people, and we want to hold hands and provide great service. So you're still going to see all of the high touch, even though we're utilizing all of the tools for the high tech. Guild being one of the largest, I mean, we normally fund $1 billion a month. Last month we funded a little over $3 billion. Fannie Mae, Freddie Mac, FHA, VA, they all love us because of the quality of the loans, and then we just send them a lot of business. So that allows us to really utilize a lot of the high-tech features that get rolled out before anybody else gets to beta test them. So we'll see more and more streamlined way of doing business, but it's not going to take from the hands-on approach way of doing business. Here's all of your income. I don't think y'all saw this. This is just all of the gotchas or the areas that you can hit snags on income, and why all of that paperwork is so important. And when I'm referring to all that paperwork, I mean pay stubs and the breakdown of the income if it's more than just base pay. For example, you've got, when we do a loan for a nurse, most of the hospitals are on the automated service, which is great as long as the information is reported correctly. But your nurses could have 3 or 4 different shift pays, depending on what day of the week they work the shift or what hours in the day they work their shifts. So, and then here's your assets and all of the gotchas for the assets. And then this is your high tech, you know, what we're using, the account check, the Equifax, and the appraisal waiver. You will not get, and we learned that last week whenever we did the trading, you will not get an appraisal waiver on FHA or VA. You still need an appraisal. It's the conventional loans that sometimes we don't have to have an appraisal. So I'm glad you said that though, because this is the slide y'all really need to write down so that you ask these questions. So you want to make sure that the customer actually completed the application. They can do an application over the phone, or they can do an application online, or of course, some places still have paper. We still have paper applications, and there's some people that just prefer to come in and actually fill out a piece of paper. But you want to make sure that they actually had filled out an application. And the reason is because a phone conversation, a lot of times, some of the information that is important gets left out. So if it was not a completion of an application where they were giving their whole life story, then it might have just been a conversation that ended up with just a current address, date of birth, social security number, just so someone could pull a credit report. The credit report, you want to make sure the credit report was pulled. Now your customers are going to get a copy. They'll get their, the FCRA notification. Whenever you apply for a credit card or anything else, how you get that letter in the mail like a week or 2 later, your customers are going to receive that. That gives them some information about their credit score and what, the credit score ranges and all that. So they'll know if a credit report was pulled. And they have to give permission to pull a credit report. So whether they do the application online or they do it over the phone, they had to give permission to pull a credit report. Now, here's a question that comes up often, and y'all need to be prepared to answer this question. If they have already applied with somebody else, so say that they did a Bank of America application and they were going to use Bank of America, and then whenever you guys were talking, you're like, hey, you're buying a property out at the lake. The appraiser matters really on these transactions, and working local really matters, because this isn't a neighborhood where every house is exactly alike. It's not cookie cutter like Bank of America is typically used to working with. So for that reason, you have got to call my local person. Y'all, we have so many good local lenders. Call my local person. They're going to take great care of you. You need to do an application and give them all the documentation they need so they can get you pre-approved, and give them permission to pull your credit report. I know you've already talked to Bank of America and they pulled your credit report too. It's okay. You have at least a 30-day window for you to be looking at lenders and doing your shopping. without it hurting your scores. So when we pull a credit report, it is going to affect their credit score. The amount of points really just matters whether or not they have been out car shopping and furniture shopping and now they're house shopping. Then it could affect the inquiries would affect their credit score more than it would if this was just the first inquiry they've had in 6 months and they're looking at buying a house. So don't get yourself in a trap where you're saying, oh, it's only going to hurt a couple of points, because you don't know that, neither do I. But if they have already talked to another lender, it's okay for us to pull the score again. Have you turned in documentation? That part is super important. What documentation have you turned in? Don't be scared to ask. You're not asking them how much they make. You're asking them whether or not they turned in income or asset documentation to be reviewed. And then, are you working with a local lender? That part matters too. You guys, these transactions are harder than they've ever been. You need to be able to pick up the phone and talk to the lender, because you're working on the buyer's behalf or you're working on the seller's behalf. And you can't work on their behalf if you can't talk to all of the people you're working with to make it happen. So working local really matters. And then, has your lender received the documentation and reviewed it? And so, no, actually, ask these questions of the lender. Sorry about that, confusing. Have you received the documentation from the buyer, and have you reviewed it all? And then also ask them whether or not they have run the loan through any of the automated systems, which would be, DU or LP, or you can just call it, have you run the loan through the automated systems? That part really matters. But you can be specific and say, are they self-employed? Have you looked at tax returns? Do you have their 2 years of history? Do you have everything you need in writing on their income to validate the information that you have in front of you? And that's what really matters. It's the validation of the information that was provided that matters. When we're doing the income calculations, there is actually a worksheet that has to be complete. And you're working the income 3 different ways, and you have to choose and document and support which way you chose to go on the 3 different income calculations. So you just want to ask those questions. Again, have you received and reviewed the documentation from the buyer? Have you run the automated systems? And if you want to go any further, are they self-employed? Have you looked at their tax returns and their P&Ls for the year? And if they're not self-employed, have you actually looked at the pay stubs and W-2s, or did you get the automated income information? All right, so next week, again, the title commitment is super important to watch, because there's just so much information on Schedule C that you guys need to be paying attention to. Schedule B has some really good information too that the buyer needs to be aware of, because that's all your deed restrictions and easements and all of the things that really matter and need to be paid attention to. There is nothing worse than a buyer moving into a home and then find out that they can't put, they can't get 3 chickens in the backyard to have fresh eggs, or just some of those things that they could have asked those questions up front if they had read through some of the information that's provided. It is information overload, which is why you and I need to know how to read that so we can be sure to point out anything they need to be paying attention to.